Alex Academy, where our plan is to build and train as many traders as possible to become financially independent. Yes, to have that financial independence in the Forex market. Alright, so today we'll be looking on a very interesting topic. Looking into a very interesting topic called risk management. Now, it has actually been recorded that one of the issues and problems Forex traders face in this market of a thing is how to manage risk effectively. They might have the whole strategy without proper risk management. It is nothing, absolutely nothing. Yes, risk management. Now, when you hear about risk management, what comes to your mind? Now, risk management as a whole refers to the implementation of some set of rules to avoid the negative impact of the market. Yes, negative impact. Enough with all the English and let's get straight to the point. Negative impact meaning losses. Yes, losses in the financial market. Losses. Alright, so looking into 5 basic risk management guidelines. Number 1 is understanding the Forex market. Number 2, building a trading plan. Yes, trading plan is very needed in the financial market. Number 3, looking into setting a risk to reward ratio. A risk to reward ratio. Number 4, looking into using stop and limit orders. Stop and limit orders. And for the last one, we'll be looking into managing your emotions. Yes, managing your emotions as it sounds. Then we'll move into the calculative aspects of risk management and how to put them into practices. Now let's go to the number 1 guideline. Now that's understanding the Forex market. Now if you're a newbie and you're just getting started with the Forex market, before you even go into the aspect of risk management, you need to understand how before the Forex market entails itself. Now the Forex market is a given sector in which you buy and sell currency pairs. Yes, you buy and sell currency pairs at a given price level. Yes, given price level. And let's go into the second one. Now going to number 2, that's building a trading plan. Now one of the reasons why most financial traders end up going out of the market sector is lack of trading plan. I tell you, lack of trading plan can help you maximize profit. It can help you maximize profit. This gives you a reason when you want to enter the financial market, at what point you want to exist, what are the symbols you see, what are the chart patterns you see. You know, okay, yes, I'm going out of this trade at a particular period of time. Now, I would always advise you, don't copy any other person's trading plan because it may actually affect you. Now, you don't know the emotional development the person has made to actually write out that trading plan. As a newbie, try to look for what works for you. It's very important in the financial market, what works for you. Then get it down in a journal. Now, I tell people a trading diary is needed during Forex trading. A trading diary to actually record your wins, your loss, and probably the emotional instability you faced, probably when you place that trade at that particular period of time. Yes, very needed. Let's go to number 3. Yeah, number 3, set a risk-reward ratio. Now, risk-reward ratio is very important in the financial sector. Why? Now, before you enter into a trade, this gives you, okay, yes, I want to enter into this trade at a particular period of time. Don't just get in blindly. No. Okay, this trade I'm about to enter, what am I willing to risk at this period of time? What if this trade goes wrong? How much am I losing for my initial capital? What if it goes the right way? How much am I getting? Don't just enter into a trade blindly. Probably see a signal say, oh yes, buy low, yes, and you're just in. No. Sit back, yes. Relax, yes, relax. Now sit back and analyze. Okay, yes, this trade I'm about to enter. Okay, I'm going to get 50 pips. Okay, I'm just going to lose just $50. Yes. Sit back and calculate. Yes, and I have a solution for you. Without going through all those stress, if you I want to go off from this stress, my FX book have the solution for you, or baby pips position pip calculator. Yes, I'll show you how to use it now. Alright, so you go to the any browser of your choice, just type my FX book position size calculator, my FX book calculator, position size calculator. Now once you get, now the time on the particular currency pair, you continue. Now I want to trade Euro USD. Now my account currency is USD. Now writing your account size, let's say you have $1,000 account size. Now your risk to reward ratio, how do you calculate this risk to reward? Now I'll be explaining in a short minute. Now let's say I want to risk just 1% of my account, just 1%. Now my pips, let's say my pips is just 20 pips. 20 pips, and I want to trade just one. Now it will give you the lot size you have to actually take that trade in. Now when you click on calculate, it gives you, now you have to enter the trade with 0.05 lot size, and once you actually hit stop loss, you are just losing just $10. That's just 1% of your account. See, now actually advantageous. Now I'll be showing you how to calculate your risk reward, your risk ratio, and how you can understand the calculation of risk ratio very well. Now, yeah, let's move into calculated aspect of the pips risk to reward ratio. Now, the formula you use is just x over 100 times account size equals to money risk. Now, your account size determines like your capital, what you have as your current balance in your Forex, your MetaTrader, and all. Yeah, the money risk is okay. The money allowing you are willing to risk for that particular trade. Now, let's say for instance I have $1,000 account, so you have x over 100 times, let's say I have $1,000 account. Now what x will actually give you is that value you will input in my FX book, that value that says percentage risk, like the percentage of your account you are willing to risk. So how to calculate it, this is what we are doing right here. So equals to, let's say I'm willing to risk just, let's say $20, yeah, for this particular trade. So if it goes wrong, if it goes negative, I'm willing to just lose just $20 alone. So just 20. So when you multiply, you have 1,000x equals 2,000. So when you divide both sides, you have x equals 2%. That's you're willing to reach just 2% of your account. So 2% of $1,000 is 20. So once it goes negative, you are losing just $20, which is 2% of your account. And don't just trade blindly. Do you understand? So I guess with this method, you'll be able to manage your risk properly and tend to have more winning rates and less losing rates. Even if your winning rate is just 30%. Let's do a calculation. And let's take, for instance, for every trade you take, you're having a 3-to-1 risk to reward. Let's say you took 5 trades, you had loss on 2, and you actually have profit on the other 3. No, you lost 3 and you won 2. So for the first one, 3-to-1 risk to reward, and you're risking $20 per trade, that's just 2% of your account. So for the first one, for the first trade, you lost it. So you lost $20, that's minus $20. For the second trade, you lost again, you lost $20, that's minus $20. For the third trade, let's say it got your TP, that's 3-to-1 risk to reward, that's $60. So that's $60. The next one too, you have plus $60. Then the last one, you lost it again. You lost the fifth trade, and you have minus $20. So once you calculate the negative, you have negative $60 plus, when you calculate the positive, you have plus $120. That at the end of your trade, you still end up with what? $60 profit, having a 40% win rate. Yes, because after for a 5 trade, you won just 2 and you lost 3. Yes, you still end up with something in your account once you have a proper risk management strategy. So I guess if you stick with this, yes, you will end up having more win rate than loss rate as you begin the financial market. Thank you. Yes, that's all on risk management. Don't forget to like this video, subscribe, and click on the notification bell to get notified whenever I upload a new video. And if you have any suggestion on probably the next video to upload, just hit me up on the comment section. And Alex, peace out.